What's up, guys? Eric here, Mr. Fired Up Wealth. Want to do a quick real talk here today, give you an update on the markets. I'm going to tell you where I think the market could be headed for the rest of 2022 and what we could see in 2023. We're going to look at some charts, look at some macro data. So we had CPI come in earlier this week, less than expected, 7.1% versus 7.3%. Of course, that's better than expected, but it's still very historically high for inflation. Now, the last two CPI reports have come in a little bit light, which is a positive thing, but the Fed is still raising rates. Yesterday, the Fed raised rates 50 basis points, so 0.5%. And we look at the federal funds rate, they're looking at 5% or maybe even higher for 2023. And you look at some of the data, essentially the dot plot is showing that 2023 could have some pressure. And I think the market's worried that the Fed is going to push us into a recession if we're not already in one already. And so there is an expectation that earnings will have a bit of a recession here in 2023, especially that first half of 2023. You can see right now, the market's down. You know, the NASDAQ's down about 3%, hovering at 10,842. S&P's down around 3,900. The VIX has spiked 7%. It's hovering around 22. The Russell's down 2.36%. You can see these numbers in front of me here. Now, looking at a heat chart, a heat map, you can see pretty much everything's down except for a couple of stocks here. You've got a couple greens. This one here has been backwards, Tesla. Seems like it's been red on green days, and then the opposite today. You got some of these, high yield dividend stocks that are green, like Verizon and things like that. But for the most part, the market is selling off today pretty aggressively. You've got mega cap tech down 3 to 5%. You can see across the board we're pretty red. And so yesterday, essentially what happened with Jerome Powell in his commentary is he essentially said that we're not going to have any rate decreases in 2023. That was one of the questions when we had the Q&A session. And overall, the labor market's still strong. And the problem with that is that the labor market being strong is kind of making the Fed keep the pedal to the metal. Essentially, the Fed wants, people to lose their jobs, which is kind of sad, but that's really what will decrease demand. Inflation's about supply and demand. And so when Jerome Powell was speaking yesterday, he was talking about how he thought the first half of 2023, you'll see a lot of that inflation is going to go away in the housing sector, but more concerns in other areas. And you got to keep an eye on oil prices. Last time I looked, we were hovering around $75, $80 a barrel. A lot of people think that we're going to go back to 100 plus a barrel. So energy stocks, things like that. But the message overall was that 2023, we're probably going to see more rate hikes. There's probably going to be 2 more 25 basis point rate hikes in the first half of 2023. And one thing that we didn't really hear Powell say is that it depends on the data. The message has been very clear for some time that we're going to keep raising rates and keep pressure on until inflation is at their target of 2%. Now, they don't think they're going to get to 2% till 2025, 2026, but they do see inflation coming down in 2023. And I personally think that inflation has probably already peaked and that it's starting to come down slowly. And I think by probably the middle of 2023, you could actually have a surprise where inflation might only be something like 4.5%, possibly even less. But at the same time, I can see where there's concerns where that might not be the case. Now, when you talk about the job markets and why it's so strong, this is something that I think is not talked about enough. We had about 500,000 people just in the United States that passed away from COVID that would be in the labor market today. So we lost those people, unfortunately, and that impacts the labor market. So there's essentially less people to fill more jobs or even the same amount of jobs. On top of that, we had an estimated 3 to 3.5 million people that left the labor force, that left the job market, that essentially decided to retire early, take an early pension, early retirement, decided maybe to pivot and quit their W-2 job like me and do something like this. 3.5 million people. So you have somewhere between 3.5 and 4 million people that aren't in the labor market because of the pandemic. So the pandemic caused, of course, lots of issues with inflation because you've got things, well, supply and demand. So demand was really low during pandemic era. People sat at home, played video games, watched TV, worked remotely, screwed around, whatever. Productivity was really low. And it's going to take time to get that back into full swing. But it's really hard when you lose 4 million people from your workforce, especially when a lot of companies were hiring aggressively. So you're having some companies like mega cap tech lay off people because they hired so aggressively, like companies like Amazon. But then you have smaller companies that are trying to ramp up to try to help with supply chain. And so you're seeing a lot of those jobs basically just shift from larger cap to smaller and mid-sized cap. Now, the risk is that if we go into recession, now the S&B market is going to start laying those jobs off, and then you're going to have more recession. But the reason the labor market is so strong, the reason that it's so tight, is because we lost so many people to fill those jobs. At the same time, too, we actually slowed down on some of the immigration during the pandemic, and so you have a lag effect there as well. CPI inflation data, it's all lagging. They're lagging indicators, and it's starting to go down, which is positive, but it's still very high. So let's look at a couple charts of, let's say, the NASDAQ and the S&P 500 and see where we could go here in the short term, and then give some thoughts of what could happen maybe in the longer term in 2023. Now, before we get into the charts, guys, I need to announce this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. You can also join our Patreon Discord community. That's patreon.com/firedupwealth. We'd love to have you in 2023. And we've got a lot of new and exciting enhancements and changes, and something really big that's going to be announced here in the next week or so. So definitely stay tuned for that. And if you want to join us in Discord, check it out. But NASDAQ, so this is the NASDAQ 100 index, the NDX. Of course, the QQQ is going to be the NASDAQ 100. I want to look at the index here and show you what's going on. So right now, you can see this moving average. We're kind of trying to hold that at 11,387. Now, you could make an argument for a bear case to go lower here. You could also make an argument for a bull case, but the reality is that we're in a range. Now, if you see here, this popped up basically here November 10th. We kind of had this run up. This is November 17th. And you can see that we've kind of traded in this range. So you can see up, down, up, down. We're kind of in this range right here, guys. And this is resistance. This R1, a little above the R1 is resistance. We got up here yesterday, 12,180. But around 12,000, 12,100 is that resistance number for the NDX. And right now, the support is kind of where it's at right now, 11,387. But you also have this line here, 11,175. The S3 is 11,036 and so on. It bottomed out here basically, middle of October at 10,440. And then it kind of retested this area here early November and then ran from there. But you can see we're still in a downtrend. You can see this goes back to December of 2021. So in the last 12 months, it's been nothing but a constant downward pressure. And you can see that we're still in a down channel all the way through here. So it's easy to make a bear case argument where you could see new lows. And I've been telling the Discord community, expect lower lows. If it doesn't happen, it's a bonus. I think you need to focus on individual stocks and try to buy them at specific levels based on technicals. Of course, do your fundamental research, your due diligence, have conviction, high quality type stocks that aren't burning a ton of cash. Because if we do go into a recessionary type environment, there could be more pain ahead, especially for those lower quality stocks that are burning cash and that don't have, options during times when times get tough, because money's expensive to lend and it's going to be more restrictive and harder to get that money. And so you're seeing some companies that are still trying to issue new shares and dilute shareholders and things like that. You could see more of that in certain names. You could see more mergers and acquisitions. We've seen Weber Grills being bought public, Coupa Software being bought, not public, but private, going private. So we're seeing some of these companies, especially like Weber, that was just an IPO, I think a year ago, somewhere in 2021, and already going private. And they're paying a premium based on today's price, but it's still way below where that stock was when it first started trading to the public. So Unfortunately, you might have a stock that you bought at the top, and it could get bought out through M&A, mergers and acquisitions, and you might just get stuck with whatever price the private equity fund's willing to pay. So I think that it's possible to kind of hold at this level. I won't be surprised if we see a little bit more washout. I don't necessarily know if we're going to see new lows this year. The reality is that we don't have a catalyst either direction. We've got really no catalyst to make us go to new highs or to get into a higher trading range. But we really don't have a lot of catalysts to go lower. I mean, everything that we heard yesterday, for the most part, we already knew it. I think that the reason the market's selling off is it ran up a little bit with excitement, maybe looking forward to maybe hearing Powell be more dovish. The pivot. You keep hearing about the pivot. So if the Fed's like, okay, well, inflation's going lower, we're going to pump the brakes, and they start telling us dovish things like we're going to start cutting rates in 2023. I think the market was hoping for that kind of news and they didn't get it. And so it's going to sell off to a certain level. If you have a catalyst, like a negative catalyst, easily can push. This is very fragile right here. It could easily go to a lower low or even retest lows. And on the other side of it, there could be positive catalysts though. Like, maybe there's resolution with Russia, Ukraine, seems doubtful. But we have a lot of issues that are lingering out there. China with COVID, they're trying to basically fix their COVID issues. They're trying to get rid of some of the lockdowns. But is that going to be a good thing or a bad thing? Is it going to spark another pandemic? And that supply chain is very critical, and it's very critical for the world economy. And when you think of just the global supply chain, and if China continues to have issues with COVID, that's going to impact companies. Now, one thing I will say is that the dollar, it was starting to come down, dollar index, and that actually is going to help some of those multinational corporations, especially because the guidance they provided us was using, assumptions that the dollar is going to go even higher. So you could see some surprises in some areas there, but at the same time, if the consumer is less healthy and we're spending less money, there's also that wealth effect. You had $2 million last year and you have $1 million this year because your portfolio is down 50%. You might spend less on Christmas. You might spend less in 2023. Right now, we've had a lot of pull through because people want to take vacations. Eventually, that's going to exhaust itself as well. It hasn't slowed down yet, but people are locked up for 2 years, couldn't travel. Now they're trying to get it out of their system. Like my wife and I haven't traveled internationally since 2019, and we really want to go. But once we go, then we might take a break for a little while. And so I think by the end of next year, you might see some exhaustion in some of that hospitality and travel type sector, which has been fairly strong. But I do think it's possible. The market's forward looking generally 3 to 6 months. So if you want my 2 cents on it, I think that there's possibility that we could see some new highs next year towards the end of the year. Now, if you look at the SPY here, I mean, it still has ran really hard from 348. It got up here to, what did it get up to? Basically the same kind of deal, right? This R1 was $409. And, it could have a little bit lower to go, 385 on this moving average. But both of these indexes are trying to basically give up some of those gains. And it might look bad or scary today when the market's down 3%. But you have to remember that just basically 2 months ago, the SPY was 348 and it's still trading at 389. That's quite a bit higher. So could it erase all those gains? And I circled this yellow circle down here, way at the beginning of this year saying it's possible we got this low. Could you still see these lows in 2023? You could. So it's possible the market could go lower before it goes higher. I think it probably trades in a range unless there's a catalyst either direction. But I do think the market might start forward looking by the end of 2023. I think things will get a lot better in 2024 and the future looks really bright 2025. And I think, there could be some epic returns in 2025 to 2030, maybe even 2035. These are the highest rates we've seen since 2007. And of course, we had the financial crisis right after that. And then we basically had a 10-year bull market rally. And I'm not saying that it necessarily has to be a 10-year bull market rally, but the longer that this spring coils, right, and we just consolidate, you're accumulating, eventually it's going to pop and eventually it will go to the upside. I don't know exactly when, but if you're accumulating and you have a long-term horizon, you're thinking of 2030, 2035, these could be generational buying opportunities. But at the same time, a lot of the stocks you buy today could end up going lower, especially in individual stocks, because sentiment matters so much. So my advice, you try to work as hard as you can, make more money in 2023, try to save more of that money, create a budget, spend less, and invest as much as you can in high quality, high conviction thinking with a long-term horizon. So look at this as an opportunity this whole year and probably 2023. But I do think there's a strong chance by the end of 2023, the second half or the back half of 2023, that things start to look a little bit brighter, especially if inflation continues to go lower and maybe the Fed does start to give us a little bit more of a dovish stance. I'm not saying that's going to happen overnight, but I'm talking over the next 6 to 8 months, you could see kind of a pivot or a change in the Fed's thought process of how this is going to unfold. Right now, the market is telling us that the Fed is going to continue to put pressure. Don't fight the Fed. So you don't go out and just buy a bunch of stuff. You make sure you have cash. You buy individual stocks at specific levels, and you try to be very disciplined with what you're buying. Build a blueprint, a portfolio that fits your needs, your suitability, your risk tolerance. Have some ETFs, some dividend stocks, some growth stocks, some spec stocks, and always have some cash ready in case things get a lot worse. This is nothing today, and it can get a lot worse. If you were buying, these lower levels, you might not even be buying anything today unless it's a specific stock that maybe has fallen more than the rest of the market. But this is just some quick analysis on the major indexes, on the S&P 500 and the NASDAQ, my thoughts on the end of this year in 2023. Of course, this is always evolving. It's not financial advice, and things can change in an instant. The macro conditions right now are very fragile, and the market could go to new highs next year, or it could certainly see new lows. And you can look at that and say, well, great, the market could go higher or lower. But I gave you a lot of information between there, and the reality is there's things that we just don't know. If something really bad happens, of course, you're going to have a reaction in the market. If things start to improve, you're going to start seeing improvement in the market. But the message here is that either way, you're accumulating, you're doing your best to buy individual stocks at specific price levels and price targets, and you're thinking about long-term, 2030, 2035. And this will create wealth for you if you can stick to your guns. A lot of retail have already left the building. I'm telling you, I've been through the 2000, .com bubble. I've been through the financial crisis. My wealth has been made through those bear markets, and I'm confident that my wealth is going to make me even that much more money over this period, but it's not going to happen overnight. It's going to take some patience. It's going to take some mental fortitude and toughness, some psychology, but hang in there, guys. Hope you guys have a great holiday season and end of 2022. I'm excited for 2023. Lots of great stuff coming in Fired Up Wealth, especially in that private community. So check out our Patreon Discord. Have a great day, guys. Have a great holiday season. Thanks for your time and attention. Take care.